We sit here and we await what could be a Fed rate cut a week from now. Munis have outperformed treasuries. Are munis getting ahead of themselves and too optimistic for that Fed cut?
Yeah, look, we think the Fed is going to cut next week. They've kind of painted themselves in a corner. But when you look at the 10-year Treasury at 2% and you look at 10-year AAA munis at 1.5%, both markets are wound pretty tight. And if the Fed disappoints about what they're going to do in the future and rates back up a little bit, that could bring some volatility back into the muni market. So now is definitely the time to be cautious in the market.
You know, there is an interesting case as well as we fold that back into a specific state, which is Illinois. And there's a hedge fund trying to invalidate a certain amount of GOs, their general obligation bonds. How do you play some of the uncertainty risk and the political risk that goes along with that?
It's interesting. So you remember earlier in the year, there was a big credit sell-off at the end of 18, and we recommended at the beginning of the year a basket of larger cap names with spreads like Illinois, like Connecticut. That trade has done really well, but now you have this overhang of this lawsuit in Illinois, and the petition is going to be heard in the middle of August. I think right now, especially for more risk-adverse investors, the best move is to take a step back, see what happens with that legal process, and be a little bit more cautious about jumping in.
Part of being a little bit more cautious, perhaps, is like you were talking about within the high yield market, which has done really, really well. You're still outperforming. This is arguably the trade of the last few years. Are you still excited about high yield given the outperformance? Are you ready to start to take some of that off the table?
Yeah, I think you have to look at deals that have done really well, take a little bit off the table. And when you look at some of the deals that are coming to market now that are highly speculative, they're more of an idea, there's things that need to be built. You just have to ask yourself, when you see all the money getting thrown at those types of deals where you won't even know if the project works for several years, and the money keeps coming in, that's a warning sign. And I think it's time to be flexible, be nimble, and really know what it is that you're buying and you're putting into your fund or your portfolio.
So when we talk about what you're buying, there's an interesting trade going on where traditionally this market is really focused on 5% coupons. But with rates so low, you can arguably right now get away with 3-4% coupons. Are you finding 3s or 4s are offering that much extra yield to make up for not having a premium coupon?
Yeah. People love premiums in munis because if munis trade at a deep discount, there can be some negative tax consequences. So the muni market is obsessed with the 5% coupon. In this low yield environment, 4% coupons protect you from that discount problem, but you might pick up 20 to 30 basis points of additional yield. To me, that's a no-brainer and something that investors should really take a close look at. Look at those 4% coupons now.
We're also taking a look at the flattening yield curve. We have a 2s10 spread on the Bloomberg terminal that's about 41 basis points, which is pretty flat. How much of that yield can you pick up without extending duration to really get in maybe just in the first 5 years or so?
Yeah, so the 5-year part of the muni curve is flat as a pancake. I think if you can find credit stories in 1 to 2 years, take those extra basis points. But you can't ignore the 5-year part of the curve because if the Fed is aggressive in lowering interest rates, that will be one of the most sensitive parts of the muni market, an area where you'll generate a lot of total return. So you have to own some 5-year bonds in this market, but I like really, really short credit stories in 1 to 2 years. Take those extra basis points. It's a good trade.
I know you're not a huge player in Puerto Rico, but we are expecting perhaps what could be the resignation of the governor, maybe as soon as today, if not this week. What does this say generally sort of about the political risk that Puerto Rico investors need to keep in mind when investing?
I mean, that's a political risk that's been there for the last 10 or 15 years, and the events going on right now show it hasn't gone away. Look, Puerto Rico investing, the new governor is going to have to walk a real tightrope in terms of managing the oversight board, trying to keep the people happy. And I think Puerto Rico investing is not for the faint of heart. I think individual investors should really, really be cautious because those politics there are just maddening.